Alperen is going to talk about what one could call the market of markets, right? That is the arbitrage choice between different capital markets. And yes, Alperen, so we're happy to have you, and floor is yours.
Thank you, Chris. So, hello, everybody, and thank you very much to Chris and organizers for inviting me to speak at this wonderful venue and event, a very timely topic. And I realize that I'm the last one standing between you and lunch, so I will try to keep it short. So as Chris alluded, I will talk on regulatory competition for listings, especially on the recent developments in the UK, which were very much driven by regulatory competition. So as you know, regulatory competition has long been a major driver of corporate governance regulation and securities regulation, and this is underlain by regulatory arbitrage, the idea of the corporate law regime as a product which firms can buy and shop for, or the idea of the market for corporate law. Both incorporation and listing jurisdictions can affect corporate law rules applicable to a firm, and therefore can drive decisions of firms on where to incorporate or to list. But for the purposes of this presentation, I will focus on cross-border listings. Regulatory competition arises because jurisdictions then attempt to compete to provide the most attractive product. There is an underlying question here why listings should matter for policymakers, but I will gloss over that point for the purpose of this presentation and assume that they indeed do. In any case, the main question to answer is what is the most attractive product and for whom? The starting point is to acknowledge that corporate insiders like managers, pre-IPO shareholders, or founders, they make the incorporation and listing decisions. And there are largely two possibilities. Either they have incentives to maximize firm value in order to be able to sell their shares at the highest value to outside investors, and therefore have incentives to opt into a regime that maximizes firm value and credibly promises the pro rata share to their investors, or they have incentives to steal and shirk, and therefore have incentives to choose a regime that insulates them from outside pressure or investors, especially if they are not punished by the pricing mechanisms. So the question is how regulators should respond to these incentives. And there are largely two schools of thought here. One school touts mandatory regulation based on the idea that higher standards of regulation and investor protection attract firms and investors alike. Good firms can credibly commit to maximize firm value and to distribute it pro rata to their investors, while bad firms are by definition eliminated. And this is, of course, assuming perfect enforcement. And cross-border listings are seen as a way for firms to credibly bond themselves to high regulatory standards and therefore signal their quality to their investors. The other school touts private ordering, namely negotiation between corporate insiders and outside investors to agree on tailor-made governance arrangements that are implemented via corporate charters, which avoids one-size-fits-all and therefore reduces inefficiencies. And in this case, good firms maximize value with bespoke governance arrangements, and bad firms are punished by pricing mechanisms and therefore driven out of market. So this is the famous contractarian theory, which only asks the regulator or the state to enforce the contractual arrangements. And in this case, cross-border listings are seen as a good case of regulatory arbitrage for firms to escape the inefficiencies of the regulation of their home jurisdiction. So this is one of the long-standing and perennial debates in corporate law, which I have no intention nor ability to settle here. But what I can say perhaps is that despite the ink spent on this issue, there has not been a clear intellectual triumph of one view over the other, at least not a lasting one. It would be more apt, perhaps, to describe the situation that we are in, kind of being in the purgatory. We know that markets are not perfectly efficient, as the second school would like us to assume, meaning private ordering and pricing mechanisms do not work perfectly. But we do not know how inefficient markets are to call for mandatory regulation, which, due to its one-size-fits-all nature, is bound to create inefficiencies itself. When we look at the practice, we see that jurisdictions subscribe to these views varyingly at different points in time in engaging in regulatory competition. But this is often not thanks to a sound conviction on the part of regulators on which theory should hold true. Rather, complex factors generally shape what regulators believe is the right thing to do. And what drives regulatory decisions is another voluminous debate in corporate law, which I do not need to go into, fortunately, for the purpose of this presentation. I will rather focus on the story of two jurisdictions, namely the US and the UK, with the emphasis being on the UK given the recent developments. So briefly, in the US, the traditionally high regulatory standards that characterize the US market, strict securities regulation, strict securities enforcement, they were seen as attractive for cross-border listing firms, especially those firms whose home jurisdiction provided weak corporate governance and investor protection. So the bonding theory, and it was supported by ample empirical evidence. At the beginning of 2000s, however, there was a reduction in foreign listings, which was largely attributed to the onerous regulatory requirements, especially following the passage of the Sarbanes-Oxley Act, whose cost the argument went to put firms off listing in the US. And this led to a debate on whether the US market was overregulated, with which not everybody agreed. For example, Professor Coffey from Columbia Law School indicated a separating equilibrium whereby the US regime rather eliminated low quality issuers. This overregulation argument, I would say, still persists given the overall decline of public markets in the US, but this did not really lead to, to significant deregulation, except for some tweaks to the SOX regime and also some tweaks to the disclosure regime for smaller companies. It should be noted, however, that most corporate law in the US is state law. Therefore, there's also a heavy emphasis and discussion on interstate competition for incorporations. So as Luca alluded in his presentation, Delaware has recently heavily deregulated with regard to the regime governing related party transactions and controlling shareholders in response to some firms reincorporating out of Delaware or threatening to do so. But this is distinct from international competition for listings, as Delaware law does not apply to cross-border listing firms in the US. So what about the UK? The UK has long been a vanguard of high corporate governance standards and investor protection. It was a poster child for its rules on significant corporate transactions, related party transactions, and one share, one vote. These rules were copied around the world, not least in the EU. It has been a big exporter of its corporate governance and stewardship codes and famous, or rather infamous, comply or explain mechanism. It boasted a close-knit group of domestic institutional investors, including pension funds and insurance companies, which closely engage with the UK companies. This group now invests very little in the UK market, but they once attracted the envy of the world, not least the US, so much so that US scholars Bernie Black and Jack Coffey wrote an article, I think in 1994 on this, partly titled Hail Britannia. So the listing rules that apply to premium listed companies on the London Stock Exchange, the prestigious segment of the London Stock Exchange, these rules very much driven by accountability as opposed to insulating corporate insiders from outside investors or pressure. And this was very much underlain by a conviction that this makes the London Stock Exchange and broadly London more attractive for firms and investors as a listing destination. But this desire to attract firms in the UK also led to some mini episodes of deregulation, which however backfired and led to more regulation, at least in one case. One example is when the Financial Conduct Authority, FCA, the listing regulator in the UK, when it waived the free float requirement, which was set at 25% for some foreign controlled companies in the mining and metals industry to list on the London Stock Exchange. Some very salient cases of abuse of minority shareholders then erupted in these companies, and FCA responded by creating a specific regulatory regime for controlled companies and their relationships with controlling shareholders in the listing rules. The second example was the chase of Saudi Aramco, which had at that time a market cap twice as much as Apple. and FCA relaxed governance and transparency obligations for state-owned companies, which Saudi Aramco was, of course, one, by creating a new corresponding category to lure it. But Saudi Aramco ended up not listing on the London Stock Exchange, but rather listed on its home stock exchange. Recently, however, there was a major episode of deregulation in the UK, a major overhaul of the listing regime applicable to premium listed companies, which segment no longer exists, by the way. And this overhaul targeted the rules for which, as I said, the UK was the poster child. The eligibility requirements, related party transactions regime, significant transactions regime, the ban on dual class share structures in IPOs, etc. So I will not bore you with the details. I refer you to my circulated paper, but the underlying theme of these changes was the strengthening of the position of corporate insiders and correlative weakening of the mandatory role of investors in corporate governance. So with this recent overhaul, the UK seems to have finally come to fully endorse the second view, having long espoused the first school of thought. And this was against the background of the dwindling of the London Stock Exchange as a listing destination among various financial centers in the US, Europe, and Asia, driven by declining IPOs, fewer listed companies, and some high-profile delistings and snubs with firms preferring the US market. And clearly preserving the London Stock Exchange has been very important for UK policymakers, rightly or wrongly, for various reasons. And in this debate, the regulation of capital markets in the UK has come to the forefront as a main cause of the decline of the London Stock Exchange, and deregulation as a fix. And therefore, regulatory competition has been indeed a very strong driver of the recent overhaul. There's an obvious question here whether this is a race to the top or race to the bottom, and the answer one will give to that question depends on how one views the merits of old rules versus new rules. But this seems to have remained almost secondary. What mattered was to create a regime that enabled corporate insiders to insulate themselves more and give less mandatory role to investors, with the ultimate aim of attracting founder-led high-growth firms, which London Stock Exchange particularly lacks. Unsurprisingly, investors objected to these changes, but the Financial Conduct Authority discounted their arguments on the simple basis that they invest in the US market without these rules. For example, they invest in the US in companies with a dual-class share structure. In the paper, I questioned this narrative, namely, was the UK market really overregulated in comparison to the US, which the UK policymakers saw as the main competitor or benchmark, or was the regulation really a main cause of the decline of London Stock Exchange? And I set out to compare both US and UK regimes as products offered to domestic firms from different perspectives. Again, for details, I refer you to my paper. But briefly, it was true that in some respects, the US regime was not regulated. For example, there was no ban on IPOs with a dual-class share structure. Or it was somehow less regulated in other respects. For example, there were fewer shareholder rights on significant corporate transactions. But in other respects, it was just functionally equivalent. For example, with regard to the rules governing related party transactions and executive remuneration, or even more regulated in other respects. For example, until relatively recently, there was nothing like SOX regime in the UK, or there is no quarterly reporting obligation in the UK in comparison to the US. So in totality, I find the observation that the UK regime was overregulated a bit off the mark. In any case, when I look at the cross-border listings in the US by the UK incorporated or listed firms, there was very little indication that they did so due to regulatory arbitrage. For instance, very few UK firms, especially technology and life sciences companies of the sort the UK would like to attract for listings, very few of them listed in the US with a dual-class share structure, which was not available then in the UK. And there was similarly not a little indication that regulation like significant transactions regime or related party transactions regime played a role in cross-border listings in the US, as confirmed by some important market players like this former global head of equity capital markets at Bank of America cited in Financial Times as saying, In over 2 decades in the city of London, I never heard a single company cite RPT rules in the listing regime as a reason not to list in London. There was a bit of discussion of this when ARM PLC, a UK incorporated firm, a very promising technology company, a semiconductor firm that can take on the likes of NVIDIA, when it listed on NASDAQ over the London Stock Exchange, RPT regime in the listing rules was blamed, but it turned out to be a red herring, as the real reason was that ARM PLC felt that NASDAQ was the natural home as the market where semiconductor peers are listed. In any case, there are clearly limits to regulatory arbitrage. Before regulatory costs, what matters most to corporate insiders and firms is the depth and liquidity of a capital market in terms of cost of capital. Again, there is a debate in the law and finance literature whether regulation leads to deep and liquid markets or whether regulation just follows such markets. But the case remains that the US currently offers the deepest and most liquid market, which attracts UK listed and incorporated firms, and UK cannot really compete with this. And indeed, some post-reform discussions relating to some firms on where to IPO after all these changes confirmed this. For example, Revolut, a UK incorporated firm, the most valuable fintech in Europe, it targets a US IPO on NASDAQ for liquidity reasons. Another point to make is that many UK firms going to the US risk becoming a small fish in a big pond rather than being a big fish in a small pond. For example, they will not be able to make it to S&P indices because they are UK incorporated, and they're not going to be able to make it to FTSE indices either because they are US listed. And this will clearly matter for analyst coverage, etc., which will then affect the valuation and liquidity of the securities listed. In terms of implications, there's a clear danger that UK has at best become a copycat, and at worst, again, prepared the ground for abuse by corporate insiders. One important point to make is that ex-ante formal shareholder rights that existed pre-reform in the UK, they were particularly valuable given the very weak enforcement of fiduciary duties of corporate insiders via ex-post litigation in the UK in comparison to the US. So lastly, what are the takeaways? Regulatory competition seems to be stronger than ever as a driver of corporate law reform, both for incorporations and for listings. There are largely two views on how to compete, into which jurisdictions varyingly subscribe, either explicitly or implicitly. But it's really hard to claim the intellectual superiority of one view over the other. UK has long been a paragon of the first view that touts mandatory regulation, but it switched tack recently, probably based on false ideas that will not help much. Regulatory arbitrage is clearly important, as we heard today already from previous discussions, but it doesn't seem to be the primary consideration for cross-border listings that happen out of the UK recently. So I end my remarks here and look forward to the discussion.
Thank you, Alperen. I open up the discussion. Are there any questions? Yes, Professor Ferren.
Thank you, Alperen. Great paper, and I'm going to be drawing on it a lot in my paper tomorrow as well. And just on your regulatory competition point, which again I'm going to be talking about, I think it's really defensive regulatory competition. I think all this idea of attracting kind of big parties to come into the UK or even into any of the European markets is not really what's going on. When you look at the Draghi report, the latter report, we're in a new era of economic nationalism.
Yeah.
And I see a lot of this being about how you keep your homegrown companies at home.
Yes.
And keep your capital at home. I just would welcome your reflection on that.
Yeah, so definitely I agree. So it's definitely driven by economic nationalism. So I think there was one point which I said I will gloss over, why listings matter for policymakers, and I think your question relates to that. So at least if we speak about UK, UK has also growth and competitiveness concerns, but I would say that so we are bleak about a lot of things in the UK, but one positive thing about the UK that it boasts a lot of innovative and competitive companies, especially from the Oxbridge arc. And it's true that they go over the pond to list in the US. My personal opinion that it should not really matter for UK economy, whether they list on NASDAQ or LSE. I mean, so in terms of real economy decisions, for example, where they will invest or where they will keep their technology, etc., at least it seems with the ARM, it is just totally invested in the UK. So it doesn't seem to be moving all the real economy aspects of its business to the US. So I am more optimistic on that front. Even if they go to the NASDAQ, it will not really have obvious impact on the UK real economy. Obviously, it matters for LSE. LSE is losing business, etc. But it doesn't even seem to be important for the big LSE, the London Stock Exchange Group that owns the stock exchange. They say it's really little of our overall revenue. So it's an interesting point. I agree. It's an interesting point why domestic firms should list in the domestic market rather than go over other jurisdictions, what effects it has on the real economy. And my personal opinion is more optimistic in that front in terms of the real impact for the economy.
Yeah, can I tie in with that? Because so the picking up Professor Alperen's view that you were suspecting that maybe this is economic nationalism, that what we see is really more defensive measures.
This is about security and defense.
Right, right. Even insidia, more social, broader speaking topics. I would at least wager that we've been seeing likewise developments point in the same direction before that came about. And just to give a couple of examples, Sebastian's topic that we just heard. One measure, now I get to make the point, one measure that the European Union took way before that new wave of economic nationalism or nationalism in general was, for example, to slower the ability to change your COMI. If you remember in Sebastian's talk, Sebastian was simply presupposing, now you shift your COMI. In fact, there are safeguards in place, like a period suspect, for example, of 6 months, where the European insolvency regulation will simply distrust all too sudden, all too recent changes of COMI before insolvency happens. Like it distrusts reincorporation with this abuse of right clause. And in this very area, Germany saw an interesting development. Somebody mentioned delistings before, okay? So the German rules on delisting used to be market dependent. It was really a market rule. So you could have different rules in Düsseldorf as opposed to Frankfurt and whatever. But at some point, German courts just glossed over these regulatory differences and just enforced one-size-fits-all solution. So what I'm saying is there is, in my view, maybe on top of that growing nationalism, there has been a deeply rooted suspicion against arbitrage decisions, more broadly speaking. It has been felt to be a bit like cheating, you know? In the sense that, so you there's always this menu approach. Okay, so you make a legitimate decision of all in this menu of corporate laws, insolvency laws, capital market laws, but there has always been this counter movement of saying, no, you're really cheating. You don't like the rules you've been given, and then you just try to flip the script. So I think that there's that too, and that has been going much longer than this renationalization of legal thinking, I feel. So maybe, but the both currents, I mean, concur. So maybe it's just hard to tell one from the other.
I think one slight addition to that is also keeping firms domestic one issue. Also, having domestic investors investing in domestic firms is another issue.
Yeah.
Especially in the UK, what we see is that the market is totally dominated by US investors. So the domestic UK funds, they all invest in the US, they don't invest in the UK.
Right.
So it's also a big problem for the UK government get these UK funds to invest in UK companies as well. And
Yeah.
I think it's also a strategic part of the current government's agenda to bring all these domestic funds to the UK.
Yeah, and maybe also as we speak, there's a second conference going on, organized by our colleague Michael Weibe, on foreign investment and on investment controls. So there are other levels at which this control interest can be brought to bear. It doesn't necessarily have to be at the corporate finance level, I'm saying. So are there any other questions? Yes.
So we've been mainly talking about trying to attract new listings in the UK as opposed to them going to the US. What I was thinking is there any, or do the same considerations that you presented to us also apply to cases where, because of the growing insecurity, economic insecurity in the US that we are witnessing, we're trying to attract companies that were previously listed in the US and are considering getting listed somewhere else instead, in particularly London. Do the same considerations apply there, or is that a slightly different case there?
I think it's a slightly different case because despite what's going on in the US capital market is still the deepest and most liquid. So I think companies would think twice before shunning the US market totally. One example I have is the Shein, the Chinese company, but it's a bad example because it's a Chinese company. It couldn't really do the IPO in the US because the SEC and Congress was not particularly willing to let it pass, and it turned to London. And UK regulators were very willing to welcome Shein. So I don't think it's a good case for the UK to attract. There will be such firms that cannot do IPO in the US due to probably Chinese firms or other firms, etc., due to what's going on. But I'm not sure whether it's a good strategy for the UK to try to attract such firms. Yeah.
Mm-hmm. Further questions? Well, then I have another one.
Okay.
Which is because so as you laid out, the competition I get is really is not really there, right? So it's not. What do we know about the factors that factor into the decision to list at one place over another, and including at which segment and everything? So who makes these decisions? Are they lawyer driven? Are they issuer driven? To what extent, how do we have to picture this?
I mean, the classical understanding in the literature is that you start with the assumption that pre-IPO shareholders or founders or managers make their decisions, and there are largely two possibilities, as I said.
But how realistic is that picture?
I mean, I think it's pretty realistic. The role the lawyers play, I guess, is just give them a menu of the options. But obviously it is the founders or pre-IPO shareholders' decision on where to incorporate or where to list.
See, I was thinking about that when Luca mentioned these fiat lawyers that suggested, oh, let's exploit the Dutch regulatory differences. I have never met that type of advocate before who is able to juggle these several legal laws at the same time. While I'm aware that there are legal firms that provide that advice, that advice is usually not brought to bear all at once at the front line. To give an example, if you have a partner advising your case in Austria, it's say a Freshfields partner. We're not funded by them, but I just mentioned them anyway. So let's say you have so not yet. Please. So let's say you're working with a Freshfields partner in Vienna. It may well be that Freshfields has that knowledge available somewhere in their The Hague office or whatever, but the probability of that particular Austrian freshfields partner having that knowledge. So how is this organized? How do they get, who brings them to these arbitrage ideas? Because of course I can buy into the ultimate decision maker being, for example, the founders, but founders never had the idea, or how about we check Dutch law? That has to be insinuated by somebody, yeah?
Well, often it works like that. If you have a startup and you look for financing, in the first round you get local business angels, people like that. They put in money, and the more rounds you make, the bigger the guys become that actually invest in your corporation. And just before the IPO, in the last round before the IPO, you usually get in very huge investors, and these are very often international investors, and they invest in the startup, and they say, okay, and then we go for the IPO, but we do the IPO in the US or the UK or wherever, because this is what we know. Okay, so this is, we don't want to do an IPO.
It's a standardization phenomenon.
Yeah,
right?
yeah, they don't want to do
Yeah.
no IPO in Germany, because they say, okay, we are international investors, we know the US market, and so we do an IPO there or in the Netherlands or wherever. So it comes actually from one financing round to the other, because the investors are getting bigger, getting more international, and then they're used to these international IPOs and not the
Right.
local ones.
Right.
I mean, at least, so in the UK case, so a lot of FTSE 100 companies, they exited London Stock Exchange and went to US. I think for them, the decision was pretty much driven by the CEO or the board, the management. And I guess they're already very big companies, so I'm not sure they depend on the local advice. And obviously the incentive for UK lawyers, I would say, to keep those firms in the UK, because if they go to the US, list in the US, if they do any secondary issuance, they're going to do in the US probably because they're already US listed. So UK firms will lose some, at least law firms will lose some revenue. Yeah.
About UK firms, and there are a lot of US law firms in UK that drive a lot of story. I'm not very familiar with IPOs and listing rules, but on sort of my side of the story, which is that it seems that American law firms sitting in London make very important decisions about lots of things, including they will hire, of course, British qualified lawyers, but it's an American law firm with, Kirkland and others. And sorry.
Yeah, and just, I mean, I think this is a fascinating question about how the legal profession is changing, but just specifically, so, I mean, I'm on a board of a very large financial market infrastructure, which is Belgian-based, so Europe, essentially. But when we have big decisions at board level, and we're not IPOing, but so not that, but I mean, sometimes we get in a US law firm, a Belgian law firm, and a UK law firm, just to make sure we have a range of different perspectives and experience.
Right. Okay. And it might be driving these merging tendencies. I mean, I'm thinking of this Kramer Herbert Smith merger they had recently. That makes sense for these mergers to happen. That is for the legal profession to reflect what we see in the market itself. Any further questions? If that's not the case, I thank you, Alperen, again.
Thank you.